Investing in the stock market can be a rewarding way to build wealth, but with so many strategies available, it's important to choose an approach that aligns with both long-term goals and risk tolerance. Two of the most commonly discussed methods are day trading and investing in broad market indices like the S&P 500. While day trading may seem like a way to capitalize on short-term price movements, research, expert opinions, and historical performance suggest that investing in the S&P 500 is a far superior approach for most investors. Not only is it less risky, but it offers consistent returns over time and requires far less time and expertise than day trading. Day trading involves buying and selling stocks within a single trading day, with the goal of profiting from small price fluctuations. On the surface, the idea of making quick profits from daily movements can be very enticing. In practice, however, day trading is incredibly challenging and carries significant risks. Day traders must constantly monitor market fluctuations, identify trends, and make rapid decisions, often relying on sophisticated technical analysis. This can be mentally exhausting and demands a high level of skill. However, even the most experienced day traders can struggle to make consistent profits. Studies have shown that the vast majority of day traders lose money in the long run. According to a study published by the Financial Analysts Journal, nearly 90% of day traders lose money after just a few months of trading. This underscores the difficulty of successfully navigating the volatile nature of the stock market on a daily basis. Additionally, day trading incurs significant transaction costs due to frequent buying and selling, which can erode profits. The pressure to time the market perfectly also leads many traders to make emotional decisions, increasing the likelihood of poor performance. The S&P 500 is an index that tracks the performance of 500 of the largest publicly traded companies in the United States. It is widely considered a benchmark for the overall U.S. stock market. Investing in the S&P 500 means buying a share of this diversified portfolio of companies, which include giants like Apple, Microsoft, and Amazon. Over time, the S&P 500 has historically delivered solid, long-term returns. The S&P 500 has averaged an annual return of approximately 7 to 10% when adjusted for inflation, which is significantly better than the average return from day trading. This long-term growth is largely driven by the steady expansion of the U.S. economy and the compounding of returns, where gains are reinvested to generate more returns. While there are inevitable market dips and crashes, such as during the 2008 financial crisis or the 2020 COVID-19 pandemic, the S&P 500 has consistently rebounded and continued its upward trajectory. One of the key advantages of the S&P 500 over day trading is the level of risk involved. The S&P 500 offers diversification, meaning investors are spread across a wide array of sectors and companies. This reduces the risk that any single company's poor performance will severely impact the overall return. In contrast, day trading often focuses on individual stocks, which can be highly volatile and subject to short-term fluctuations that may not reflect a company's true value. Warren Buffett, one of the most successful investors of all time, has long been a proponent of long-term investing in broad market indices like the S&P 500. Buffett is known for his ability to pick individual stocks, but he has also repeatedly emphasized the power of investing in low-cost index funds for those who prefer a more hands-off approach. In his 2013 letter to shareholders, Buffett famously wrote, "The best thing that young people can do is invest in a low-cost S&P 500 index fund." Buffett's recommendation to invest in the S&P 500 is based on decades of experience and a deep understanding of the market. He recognizes that, while active stock picking can lead to large profits in certain cases, it is extremely difficult to do consistently over time. Instead, Buffett advocates for investing in the broader market, which has historically delivered strong returns and offers a safer, more reliable path to wealth accumulation. Buffett also points to the compounding effect as a reason for favoring long-term investments in the stock market. By holding onto investments over many years, an investor allows their returns to compound, leading to exponential growth over time. This contrasts sharply with day trading, where frequent buying and selling usually prevents investors from realizing the full benefits of compounding. Investing in the S&P 500 requires far less time, effort, and expertise than day trading. Unlike day trading, which demands constant monitoring of stock prices and fast decision-making, investing in the S&P 500 is a relatively passive strategy. Investors can buy an index fund or exchange-traded fund (ETF) that tracks the S&P 500 and let their investment grow over time. This approach is well suited for those who do not have the time, desire, or ability to actively manage their investments. The beauty of investing in the S&P 500 is that it capitalizes on the long-term growth of the U.S. economy without the stress and volatility associated with day trading. Historical data shows that, over the course of several decades, the S&P 500 has consistently outperformed the majority of active traders, including many professional fund managers. In fact, in 2007, Buffett made a $1 million bet with a hedge fund manager that an S&P 500 index fund would outperform a portfolio of hedge funds over a period of 10 years. When the bet concluded in 2017, Buffett's bet had grown by 85%, while the hedge fund portfolio had only gained 22%. While day trading may offer the allure of quick profits, the reality is that it is a highly risky, time-consuming, and often unrewarding strategy. Most day traders lose money, and even those who manage to make profits struggle to do so consistently. On the other hand, investing in the S&P 500 provides a diversified, low-risk approach that allows investors to benefit from the long-term growth of the U.S. economy. It is a strategy endorsed by some of the world's most successful investors, including Warren Buffett, who has long advocated for investing in broad market indices like the S&P 500. By choosing the S&P 500, investors can take advantage of compounding returns, reduce their exposure to risk, and avoid the pitfalls of day trading. In the end, the key to successful investing is patience and discipline. While day trading may promise quick results, it is the long-term approach, such as investing in the S&P 500, that has consistently proven to build wealth and financial security over time.